Hey there, it's Tim from eMoneyMind, and this video I want to walk you through the put hedge trade. This is something I do ahead of the Fed meeting announcement. You can take advantage of this trade when you have a long position and you think the market's going to go down and you don't want to have to sell out of your position and perhaps miss out if the market does end up going higher instead. You can use it for just little pullbacks and you could use it even if you're not necessarily hedging a long position. So the benefit of buying puts versus just shorting a stock or shorting, selling futures is that you can take advantage of the sort of acceleration of profits and deceleration when it comes to losses. So, you know, options can be a fairly complex game, and certainly the way the option price is structured, we've got the intrinsic value and the extrinsic value amongst a whole other feature, a whole other gamut of inputs that come in to make the Black-Scholes options model. And without getting into those specifics, let's talk about how you can take advantage of buying puts to really capitalize on a down move. And so, what I like to do, because puts are, anytime you're buying an option, if it's you've got this piece of the option that is implied volatility. So the VIX, the volatility index, when it's really high, the option price is going to be really high. When the VIX is low, the option price is going to be much lower. When the option is going in the direction that you're buying, so if you're buying puts, you want the market to go down, just straight up puts. If you're buying calls, you're betting that the market will go up. And buying calls when the market is up is going to make that call option more expensive. Buying puts when the market is down is going to make that put option more expensive. So, what I like to do is do the opposite. And so, what I'm looking to do is buy my puts when the market is up. And so, rather than just buy puts on any old up day, I like to buy them when we close at a 50% retracement on the daily chart, a 50% retracement short to be exact. So ahead of the Fed meeting announcement that happened yesterday, we had a close right at the 50% last week on the 28th, and we closed a nice bullish candle right at the 50% short. And so knowing that we had the Fed meeting this week, I wanted to jump into a put hedge ahead of the FOMC meeting announcement and right at the 50% short. So I put in the position here at the short, and what I like to do is use the SPY as my vehicle for buying put options. So what I like to do is take a look at the price, where we're closing. We were right about 390. And so when it comes to the option itself, you want to think about a couple of things. You've got the strike price, which is the price of the option as it relates to the underlying stock. And it might be easier if I go to the trade tab and we look at some of these. Let's go to the SPY. So the price of the option is what you're going to pay. And so when you see the number on the bid ask over here, you really have to add, move the decimal over 2, and that's going to be the price of the option. So if it's, $2.40, you're going to pay $240 per contract. And then the strike price is where that contract, is essentially related to on the underlying stock. So right now, you can see the shaded area versus unshaded, 372, 373. That's because the SPY price is hovering right above and below that. We're right at 372.93. And so anything that is below that strike price, the current price of the stock, or in this case the ETF, is going to be considered in the money. And anything above that, when you're going short or buying puts, is out of the money. I like to buy them close to at the money, meaning the strike price and the actual price of the SPY are pretty close. And I like to keep them, at $5 or below. And so what occurred last week when we rallied up to this 390, the 390s were still a little bit expensive. Volatility has been coming down, but it's not like it's in the low teens like we used to be. So the 390s were a little bit expensive, so I went to the 385s. So still pretty close to the strike, and those were, right now they're very much in the money because the market has sold off, and now 385 is up here, but we're trading at 373. And so at the time, 385 would have shown up right around this 73, 74 at the money. Just a little bit above, actually. It was out of the money at the time, but it was fairly close, to a couple strikes away from the at the money. And so buying those puts, that's the strike price component. Then you got to ask yourself, okay, what expiration do I want to use? And the expiration is the day they're going to expire. And the SPY has a whole host of options for your options, everything from weekly, monthly expirations. And so when you pull up a calendar, you can pretty much pick just about every Friday, and even we've got the weeklies, so you can do multiple days throughout the week. I like to pick an expiration beyond the catalyst that I'm looking to hedge. So in this case, Wednesday was the FOMC meeting announcement. I wanted to hedge in case we gapped down on Thursday. We ended up selling off pretty heavily on Wednesday as it was, but I went ahead and used the Friday, tomorrow, the 4th, as my expiration. And with the expectation that, okay, if we gap down on Thursday, I can take the profit and walk away without having to pay for all this extra time. When I'm looking at those expirations, really a couple of weeks at most is all I go out. So 2 or 3 weeks is usually the most time that I'll give it. And in this case, because we were only a week away from the Fed meeting, using 1 week expiration was fine. I was actually planning to buy some more puts with a little if we got to move up on Monday. This was Friday. And then Monday we ended up with a little bit of gap down, so I didn't end up buying more. I just had the one position from the close at 385 with the November 4th expiration. And so we had a sell-off on Tuesday, a big sell-off on Wednesday, and then today we gapped down. And so rather than, when we talk about exiting the position now, rather than waiting and waiting and waiting for them to expire, you want to be on the offensive when it comes to taking profits. And so if we draw up the opposing halfway back, you can see this morning when we gapped down, we sold off and we traded at this 50% long. And so knowing that, okay, I've got a contract that's expiring tomorrow, I went ahead and just took this off at the close. Typically, I would tell you to wait until at the open when we move down. Typically, I would tell you to wait until the close to make a decision on a trade. But when it comes to taking profits, if we do have a sizable gap down or a move down to a support level, I'm okay ringing the register. I also like to take a couple of contracts off the table on a big move down if that occurs right away. So like, let's say I bought puts here on the 13th, and then the 14th we had a really big or a pretty big down day. Taking one or two contracts off just to ensure a winning trade is a nice way to allow yourself to cash in, but also have most of the position still on. Let's say you got 10 contracts and you sell two. You got 80% of the position is left. You've reduced some of your risk by taking the gain, and then that allows you to kind of stay in the trade longer. It's helpful to close out the position when the market is moving down, because like let's say if we just go back here and we say this day ended up at a hammer, but let's say we sold the low of the day. Okay, we sold it right here. Well, if we go 5 days before the market really, sells off and goes much lower, if our expiration was, on the 4th of October, these 5 days where the market's going sideways, your contract is really just losing value. And so by the time you get to this fifth day and it sells off even further, you may end up have the same contract value as if you sold it earlier on the momentum with the move down. So um, I try my best to exit the trades typically at the close, unless we have a gap down at the open and I'm taking a profit. But I tend to exit them sooner rather than later. I never really wait to expiration just to give it more time because you're just whittling away at whatever contract value is left. And then as far as let's say we went up on Monday, the market moved up. Where would I exit the trade? I like to see a close since I'm getting in at the 50%. I like to see a close above the 61.8. So it needs to close above the 61.8, not just trade above it. Whereas intraday, when we're doing futures trading stuff, a move above the 61.8 is fine. If we, where was it at here? If we look at this little long on the SPY, look at all of these days where we not only went below the 50%, but we poked below the 61.8. All these days in here we're going below the 61.8, but we didn't actually close below the 61.8. That's actually pretty bullish. So if you take that same scenario and turn it upside down, that's what we want for a trade to, in order for it to cause me to exit and take a small loss on the trade, I want to close above the 61.8. And, with the option going against you, let's say you buy it for $5 and it closes above the 61.8, you might close it out for $3. And so the loss on the trade, I like to use $5 as kind of my general max per contract, just because, if you use $5 as the max loss, I'm comfortable with that. And if you're buying 10, 20 contracts, you kind of, okay, $5 times 10 contracts, that's my max loss on the position. But realistically, if it goes against you, you might only be taking, a $200 loss per contract, or $250 per contract. And so because you're exiting fairly quickly after it went against you, if you got in on Friday and then Monday we had a ripping rally and we closed above the 61.8, I would just close it out as opposed to saying, well, it could come back, because then you just wash away the other half of the position that you have left if you wait till expiration. So I'd rather take that money that I still have in the contract and put it towards a future short. When the market's in the strong uptrend, looking for a swing low to break and then taking the first halfway back short after that is a really good place to look for those 50% retracement shorts. Ahead of the Fed meeting announcement is what I like to do a lot of the times. And pretty much any time where we get a bounce to a 50% retracement short. And so by using just that simple framework of, okay, I'm going to buy puts when we rally to a 50%, and I'm going to buy it on the close when we close at or near or even a little bit within the 50% retracement short. And then I'm going to exit the trade on a strong move down, after some sort of catalyst or at some sort of opposing 50% retracement long or a potential support level or a prior low. And the other nice thing is, you can exit a couple of contracts at a time. So let's say I had another 2 weeks until expiration, and today we traded at the 50% long, and I had 10 contracts. I could sell 5 at the open today at the gap down to the 50%. And if we went a little bit lower tomorrow and it looked like we were about to break the 61.8 near the close, then I might say, okay, we are failing this halfway back long, and we have a good chance to make it down to the 350 level again. And so then I can, hang on to some more of those contracts and sell the other 5 in pieces as well. I could sell another two, and then the final one. And so, um, you have a lot of options with your options, and as long as you're buying them, somewhat close to at the money, if it goes your way, you can quickly get in the money. And then when the market's going down, you tend to have a rise in volatility. So the implied volatility actually helps raise the price of your option, even if the SPY isn't necessarily nosediving off a cliff. And so there's a lot of benefits to going to buying puts over buying calls. And if you have a long position or a 401k, this is a great way to just keep that 401k or that long-term position intact, keep collecting your dividend, buying more shares, and then you can use the money from your puts to okay, hey, the market's bouncing here. Let me buy a 50% retracement, buy puts at the 50% retracement short at the close on the day where we end up at that 50% retracement short, and then write it down to like the negative 23% target. Um, this was a day where we closed very strongly bearish the day after the gap up or the move to the 50% retracement short, and so you take a couple off there just to lock in some gain, guarantee a winning trade, and then let it go down to negative 23, and you've got 3, 4, 5, 6 in 7 days. This thing went from 410 down to 378. And then it kept going. But even if you don't catch, the entire move down, you're catching a huge chunk of the trade. And that $5 or sometimes even a $3 option can turn into, you're spending $300 for the contract, and you can close it out for $2,000. You start all of a sudden you start getting 4, 5, 6, 7 contracts, and you can really pile on some good returns that you can take that cash and then those profits and then invest it into either the stock that you're hedging or elsewhere, or just use it on its own as its own strategy where you're not actually hedging. So hope that was helpful. If you liked the video, give it a thumbs up. If you have questions, drop them in the comments below. Wish you good trading and have a great rest of your week.